Hello everyone, I'm Ted Oakley. I'm here at Oxbow Advisors with our quarterly call, and today we're going to be talking about a few things. We'll break it down into the economy, what's going on in the bonds and the interest rate markets, and finally wind up with the stock markets and hopefully give you an idea of some things we're talking about right now. If you check out our themes right now, you'll see that this has been one of the toughest years ever to manage money. The volatility continues. It's been incredibly hard this year because we've had tremendous volatility. If you notice how many days this year have been up or down more than 1%, it's a record term. So it's something we're really looking at. In addition to that, you're noticing the election, or you're noticing what they call the stimulus, which we think is just merely a lifeline. There's no stimulus to it really. It's just handing out money. It did have some impact, unquestionably, from the early summer on. You'll see what's happening with that. And I think once we get past the election, we'll get a better look at see what's happening. The other thing we're contending with is low rates. There's a big war going on right now between the people that think rates will stay low and people that think that rates are going to go quite a bit higher. You'll see where prices and stocks are high, and they've been high really now for the last 4 months. But particularly the last 2.5 months, we're seeing that. And then we have this ongoing debate right now with people about inflation and deflation. So if we get into the economy a little bit, let's look at some things that are working correctly. And you'll see here where the National Association of Home Builders Optimism Index and their expected single-family home sales coming forward are at all-time highs, and that's over the last 20 years. This is a really strong market right now for residential in almost every part of the country. These low interest rates have made it such that it's on fire everywhere. You know, you get into a situation though where I think people will probably miss the point a bit with it, and they'll probably overshoot this area, pay more than they should because of where rates are. And if you'll notice what's been going on with individuals here, you'll see where between their stock prices and their home prices, they're happy. You know, the prices have come back up on their stock and their 401ks. Their home prices are doing well. So they get this feeling that, hey, it looks pretty good, even though the economy's not doing that well. So what is happening with the economy? Now, this is a graph right here I think you really need to take a hard look at. It's permanent job losses. This will probably increase another 50 or 100%, we think, over the next 6 to 12 months. Which will be a very, very large number of people who have permanently lost their jobs. That's what you cannot fix with checks or a stimulus or something like that. Those are only short-term things that make people feel better because they have some cash. But the permanent job losses are a real problem. The other thing we're seeing is that the stimulus we had earlier is starting to basically underperform. In other words, we're not getting much out of it now. People have spent the money, and you're starting to see the personal income start to come off now, start to wane. That's why you're seeing these screams from the Congress and the President and everybody else that wants to have more stimulus. But it's not stimulus. It's basically money giveaway, and so they have money to spend, and that's why you see this personal income number up with actually the jobs are horrible. And the reason why is because we've basically given them money. The other thing you'll see that's going to be a problem over the next 15 to 18 months is that you're going to notice there's going to be a tremendous amount of business, particularly small business, that's going to go insolvent or go under. We think that basically the Congress and legislature, they missed this completely, even the Treasury and the Fed. They've done everything for the stock market and the bond market, but they've completely left out small business, which is where you get most of your job creation really is in small business. One of the biggest problems we see is on this particular slide. And I'll point something out to you here that I want to make sure that you understand the two growth rates. One is the growth rate of debt that we've taken on between the Federal Reserve and the Treasury. And the lower bound is what we produced in this country, call it our business and gross domestic product. So notice these two numbers. What I've done is circle the growth rate of the U.S. debt here. We're up to $27.2 trillion, a number that you probably can't think about. And they're getting ready to want to do another 2 trillion, maybe 3 trillion. And if you look, and that's a 9 to 10% growth rate in the last 12 years. But if you look below at the gross domestic product growth rate, it's about 2%. Now, if you're operating a business out there and you're growing the business at 2%, but you're raising your debt every year between 9 and 10%, how long do you think that goes on before all of a sudden you have a real problem? The other thing I want you to be aware of is that we are in changing times. If you look at this graph and look at, these are every 2-year election cycle we've had, going back a long way, all the way back to 1960. So it's a 60-year graph. You'll notice in this last 10 election periods, we only had 2 periods when we didn't change something, either the Senate or the House or the presidency or some or all of both. So it's not going to be unusual to see these changes, and I think that's just a matter of where we are in time now as we go forward with social media and the like. Let's look at what's going on in the bond market. In the bond market right now, I'm just giving you an idea of what the yields look like. The U.S. 10-year yield at 0.77, and I know that sounds low to you, but that's actually higher than anything else you see. United Kingdom is 0.24. You'll see Japan at 0.03, and negative rates in Germany, France, and Switzerland. And so the U.S. has the highest rate, and that's why they keep buying our bonds. One of the big factions that are against each other right now is you have a whole group of people that think we're going to reinflate and the rates are going to go up. And another group thinks that rates will probably go to 0 on the long end, 20 and 30 year, and maybe even negative. But this came from the Fed 2 weeks ago. And what they said is we're considering going beyond the 3-year boundary and possibly buying bonds, treasuries that are in the longer maturities. This made us feel like that perhaps they might try to take the 20-year or 30-year bond quite a bit lower at interest rate levels so they could create more activity, such that you're seeing in the housing market right now. They haven't done that yet, which has surprised us a little bit, and maybe they're just letting it drift up and they want to do that, but that's what we're seeing. But just to put that in perspective to you, if you just take the current 20-year bond yield, and let's say these two factions are going at it, and one says, well, if rates go up 1%, you're going to lose, in 1 year, you'll lose 18% of your principal, which is a big number. The other group is saying, well, if rates go down 1%, which that's what they feel like would happen, you'll make an extra 16% on your principal. You see that fight going on right there. And what we try to do in our fixed income portfolios is we've tried to hit a happy medium. We do have some long-term paper, but we've got a lot of short-term liquidity, more than we've had really since 1999. The other thing we're noticing is in commodity prices. And I could put a lot more up here than these, but I've got up here corn, sugar, and hogs. But I could put aluminum. There's a lot of things we could throw up here that you'll see are starting to increase. And they're higher than they were back last year in the fall. And so we're seeing some signs of inflation in some of these what we call scarce items for sure. So let's move on to the stock market, and I'm going to try to give you a picture of what's happening today, because the number one question we get is, why do these stocks go up when they don't make any money? And one of the reasons is, starting last fall, when these companies, you'll see these top 4 or 5, started trading stocks for no commission. That set up a situation to where these small investors, and I'm saying small, $500, $1,000, could stay at home and buy or sell something and not pay anything for it. In other words, semi-casinos, semi-Pac-Man type stuff on the stock market. So what happens is you get a tremendous amount of people that are in this so-called game that don't really know what they're doing. One of the things we notice so much is in the options market. Now, for our investors, they don't see the options because that's not what we're doing with them. But the option market, which is a very speculative market, by the way, it's just an option to buy or sell a stock out into the future. But you'll see with this black line that all of a sudden, the single stock option buyer, that means these little bitty people can only buy one. Most people are buying hundreds, okay? Or 10 or 20 or 30. They have enough money to buy one. They are now really a high number, almost 38% of the total stock volume, option volume that's out there. They're almost 38% of the total option volume that's out there. So we know the speculative fever is running high. The other thing that's running high is what we call special purpose acquisition corporations. This is a group right here that came around in the 80s, in the early 90s. They were basically run out of town because they had a lot of shams that went on. We had to get the regulators involved, and what it means is, look, I have a special purpose acquisition corp. You give me money. I have no idea yet what I'm going to do with it. I'm just going to buy something, but you have to trust me that over the next 18 to 24 months, I'm going to buy something, and then you'll own shares of whatever I decide to buy. Now, you would never do that on a private company. If somebody came to you today, a business person, said, hey, just give me your money. I don't know what I'm going to do with it yet, but we'll do something with it within the next 2 years, and you'll be happy. I doubt that. But you'll see what happens now. We have this tremendous amount of these. They come every week now. And that just tells you that the speculative fever is super, super high right now. And this is the highest we've been since 2009, this group. The second thing is initial public offerings this year are going to come in higher than any other year going back to 1990. So that's 30 years. And that's in a year when we had this horrible economics, we've had COVID, we've had problems all over the world, and yet Wall Street has been able to push out all of these initial public offerings of brand new companies, many of which, by the way, make no money today. Just today, there were 3 car companies, electric, that came out in the early summer. They average about 12 to 14 employees each. They have no prototype. They don't even have a production facility, and they're all valued at about $1 billion. Never happens. You take Zoom today, that's a real good example, sells at basically 100 times revenue. And if they increase their revenue at a high multiple in the next 10 years, and they paid you all the revenue, you probably couldn't get your money back in 10 years. That's what's happening in the marketplace. So if you look at this year, what's happening, if you take the highest flying, hottest stocks on the marketplace, and that would be all the names that you're very familiar with, they are in the NASDAQ, what we call the NASDAQ 100 average. And you'll see here from the very low in March, the third week in March until now, that average is up about 71%, which is a lot, okay? Now our stock accounts are ahead of the averages. They're ahead of the S&P 500, but they're not ahead of the NASDAQ. Our Chief Investment Officer, Chance Finucane's done a fabulous job this year with stocks, even considering that he's carrying about a 30% liquid portion to the portfolio. But here you have the really high-flying stocks. They've gone a long way in a short period of time, about a 7-month period. Can they go further? They could, and I'll tell you why. It's not that we're going to be in that area, but I can tell you why. Because if you look at year 2000, because I was in the middle of this myself back at that time, from a 7-month period, basically, if you look here from the fall of '99 till April 1st, call it, of 2000, you had a 100% move in the NASDAQ 100, an incredible number. However, and I wanted to make this point to you, that over the next 2 years, it lost 84% of its value. Went from 4,800 to about 800, and it was a tremendous meltdown. It just didn't work that way because too many things weren't priced right. Which leads us to believe from this point that, and this came from our Oxbow library, courtesy of Rusty Pierce, but this came from year 2000. And we try to remember, you got to watch these trendy stocks so they will blow you up in time. So where are we today? Where are we and what are we doing? Number one, we're continuing with high levels of cash. The only thing that you can guard against a really poor time when something out of the blue happens, the only thing that works for you are going to be either treasuries or cash. We have a lot of both. And one of the things that people say is, I'm not making a lot of money on the treasury, and I understand that, but you have to have, in these times, an insurance policy. I mean, you don't think anything about insuring all the things you own. Okay, well, this is something you own, and you need to insure it as well. And the only way you can do that is have some liquidity factor to fall back on right now. And the higher that speculative activity goes, the more we lean into that right now. And that's why we have that. If you look on what we're also doing, we're monitoring inflationary effects. That's a big thing for us right now. You'll see some movement in our income accounts where we're trying to situate the portfolios so that we can have some of both. I mean, it's a very hard call right here. We could get movement either direction, and we could get movement one direction and then all of a sudden come back the other, because there's a lot of activity in the interest rate bond market right now. If you'll see where our emphasis is with stocks, you'll notice that we own a lot of stocks that are in stay-at-home online retailers, the cloud technology. Like I say, Chance Finuca's done a great job. He's our Chief Investment Officer in that area. We've had a great year in both, and really both of those particular stock strategies. And then we've also looking at companies with growth. I might say this about growth. There's not that many companies that are growing 12 to 15% over the next 10 years, or at least the next 5 years. If you look at the year 2000, we probably had 250, 300 stocks that could grow 12 to 15% over the next 5 years. I don't have the exact number now, but I would bet it's probably not more than 50 stocks. So you've gotten really narrow on the companies that can grow, and that's why so many companies don't grow right now. The other thing that we have continued emphasis on are cash flows. And what I mean is cash flows from income. Our high income accounts have done the least of any this year. And we're a little bit in a quandary on it because we own very high yielding things. Like we own real estate investment trusts. We own a lot of great preferred stocks, convertible bonds. We've got we've got some foreign bonds. And you look at everything we own in there, they cash flow anywhere from basically 5 to 10%. But yet people are not interested in that. They want a lot of the high flying things that are going on. But we think in time that will come around. That'll be an area where people look at. So to let you know, that's where we are. We feel like that as we go forward, we've got a setup to where we feel like we can garner the gains that are going to be there without having to run the risk of some substantial meltdowns that could come from all of this. So as we leave you today, just know, and it's, we're a week or two before the election here. Unfortunately, I don't know what'll happen after that. I wish we had a crystal ball, but just know this, that we're looking out for you. We think we have the right setup for what we're going to be seeing the next 2 to 3 or 4 months. But if you have any questions, certainly call us or come and visit us at oxbowadvisors.com.